Welcome to our Financial Literacy Education series. My name is Corin Jacker. I'm from Priority One Wealth Management Group. During this series, we're going to cover a range of topics to help you better understand your money and to help you become more engaged with your money and hopefully to help you make better decisions about your money. In today's episode, we're going to be covering off wealth creation. If you haven't already seen the episode on cash flow and budgeting, go back and have a look at that because it's really important to understand your cash flow, your money coming in versus your money going out, and your budget with the aim to identify a surplus amount of income that you can put towards wealth creation. Because without that surplus cash flow that we can save and invest, we can't consider what the options are in relation to wealth creation. There are four main concepts of wealth creation. They are investing in your own name, debt reduction, superannuation, and gearing. Have a look at our other episodes on investing in your own name and debt reduction and gearing. And today's episode, we're going to focus on superannuation. Let's start by looking at superannuation as an example about how money goes into the fund and how it gets invested. So in this example, I've got someone who's earning their last $10,000 worth of income. And let's assume they're on an average marginal tax rate of 34%. So when they earn that $10,000 worth of income, they lose 34% tax. So they have $6,600 to invest. If they invest that in their own name, and earn income from that, that income will be taxed at 34%. Depending what they're investing into, if they have a capital gain on that investment, and depending on how long it's held for, that gain could be taxed at 17%. Let's compare that to putting money into superannuation. Now in this example, we can either put money into superannuation by way of salary sacrifice, so putting extra contributions through your pay through your employer, or making a personal deductible contribution with your superannuation fund. If we put $10,000 into superannuation as a deductible contribution through your pay or personally, you don't pay tax on that $10,000. So you save yourself 34% marginal tax rate income tax. The super fund, however, pays 15% on those contributions. So there's $8,500 that will be available to invest. So on day one, we're almost 30% better off by having money ready to invest in superannuation versus the net pay that we would have received ready to invest in our own name. When that money is invested in superannuation, it'll pay tax at 15% on the earnings while we're working. If there's a capital gain in the super fund while we're working, it may pay tax at up to 10% of the fund. But one of the real advantages of superannuation is when we're retired and over 60, it's a tax-free world. So there's no longer any tax paid on the earnings, there's no capital gains tax, and there's no tax taken from when you withdraw money from the fund. So let's look at some of the key points though we need to consider when looking at superannuation. So the first myth that I hear a lot is that they don't want to put money into superannuation because it's a bad investment. The reality is superannuation is not an investment. It is simply a tax structure. It can invest in investments much the same as you or I can, whether it be money in the bank, term deposits, property, shares, it's broadly the same. So if you're saying that you don't like superannuation because it's a bad investment, what you're really saying is that your investments within your superannuation fund aren't performing well. One of the main things we need to consider with superannuation is the preservation of super. So what I talked before about in relation to the tax benefits you get by putting money into superannuation versus taking it yourself. and the tax benefit that you'll have in your retirement. That's the carrot. The stick is the superannuation is locked up until you reach that preservation age. For most people, that'll be at least 60 years of age. So if you're in your 20s and 30s, it can often be impractical to put all your money into superannuation. But it can still be considered as an effective wealth creation tool, alongside the others that we'll cover in other episodes. So what are some of the issues that we need to consider in relation to superannuation? So first of all, let's consider how we can contribute to superannuation. So I touched on before, in our own name, we can make contributions on a pre-tax basis by putting money through our pay and our employer and creating a salary sacrifice arrangement, or we can make personal contributions direct to the fund and nominate to claim a tax deduction. There are also a couple of other ways we can put money into superannuation that provide a benefit. One of those is the co-contribution, where if you're under an income of around $40,000 a year, you could be eligible for the co-contribution, which means if you put in $1,000 into your fund and not claim a tax deduction for it, so it's after tax money, the government may contribute up to $500 into your fund. So it's a good way to get an immediate return of 50% on $1,000. Another one is a spouse contribution. So if you're working and you're in the higher marginal tax brackets and your spouse is earning again less than around $40,000, you could put in a spouse contribution of up to $3,000 and potentially get a tax rebate of up to $540. When looking at co-contributions and spouse contributions, just be aware of the thresholds as they are at the time. They do change. In terms of putting money into your own superannuation fund, on a pre-tax basis, we covered that through employer contributions, but you can also put money in on a post-tax basis. And this is quite common if someone receives a large amount of money, such as an inheritance or an asset sale. When putting in pre and post-tax contributions, there are a couple of things that we can take advantage of. With post-tax contributions, you can put in up to $110,000 a year currently, but you can also bring forward 3 years worth of contributions. So in any 1 year, you could potentially put in up to $330,000 into your super fund with post-tax contributions. You won't be eligible to put any more for another 3 years because you've brought forward those 3 years worth of contributions. In relation to pre-tax contributions, currently we can put in up to $27,500 into our super fund each year. Now don't forget, that includes your employer contributions as well. One of the things we need to remember about pre-tax contributions to super is that since the financial year of 2018, unused caps that we don't use, so for example, if I've got an employer and they put in $10,000 a year superannuation guarantee contributions and I've got $17,500 a year remaining, if I don't use that, under the new rules, that gets carried over for up to 5 years and it can be put into your super fund as an additional contribution above your normal caps for future years, as long as your super fund has a balance below $500,000 currently. That's a really good option for people perhaps in their late 40s, early 50s, where they're currently not wanting to lock up too much into superannuation, but in years to come, may be able to really take advantage of some higher caps that they might have accumulated over the years. You could also consider splitting your superannuation. Talk to your super fund. There are ways where you could put in money into your superannuation and then you have the option to nominate to have some of those proceeds transferred to your spouse. And this is good if one person has a significantly higher amount of superannuation than the other in a partnership. This is a way to help equalise it a little bit. I've put a note on the screen about self-managed super funds, which we haven't really touched on today. and also thinking about property and superannuation. So we're going to look at in other episodes the whole concept of self-managed superannuation funds, and also once we've looked at gearing, we can combine the concepts of superannuation and gearing by looking at borrowing money and buying property in a self-managed super fund. So don't forget to keep an eye out for those other episodes on wealth creation, saving money in your own name, debt reduction and gearing. Thank you and goodbye.